Hello, and welcome to our Halftime Report 2023. My name is Trevor Wilde. I'm the CEO of Wilde Wealth Management Group. Many of you have been participating in this event for many years. The Halftime Report is an event that we've done for almost 15 years now, and it's one of a two-part series. The first part of this series is an event we do at the beginning part of the year that we call our forecast event. The mid-year report, our Halftime Report, we like to look at the markets in the first half of the year and the events that we believe will be occurring in the second half of the year. Now, over the years, different advisors and some of our partners will help host this event. I'm happy to report that Jeff Anthony, one of our great advisors in our Tempe office, will be presenting the bulk of the material today. But before we get into the meat and potatoes, I thought I would take a few minutes to put some names with some faces. Our leadership team, and I have to say I'm so proud of the people that work tirelessly day in and day out to support Wilde Wealth Management Group and ultimately you as our clients. Our leadership team, myself, Jackie Yoder is our Chief Operating Officer, Janine Lackey is our Chief Compliance Officer, an amazingly talented couple individuals there, and I'm super proud of them for everything they're doing with us. Our investment professional team has expanded. Many of you that have been with us for the last 15, 20, 30 years know this, that we've continued to look and search for talented people. I'm not going to go through all the names and faces, but you can see them on the screen, and maybe even for some of you have the first opportunity to see what they look like. I do want to make a special welcome to Jonathan Fagan. He's our newest investment advisor who joined us earlier this spring and is located in our Scottsdale office. As many of you also know, we have many offices around the valley. Our primary office was the previous here in Scottsdale. It's where I am today recording this halftime report. We moved into our Scottsdale office in 2003. We've spent more than 20 years here in this same building. We should own it by now, but we don't. So this is our hub. We have an office in Tempe that houses a handful of our advisors and some support staff. We also have an office in Glendale, in Payson, Arizona, Sedona, Arizona, Tucson, and we opened an office with an affiliate in San Luis Obispo about 2 years ago. So again, I'm not going to go through each of these, but just so you can get a name to a face. And also, if you weren't aware, we might have offices in your backyard and are happy to arrange meeting with the advisors that are in that office. Our client service team is really the blood of the organization. It keeps it pumping. I should say not the blood, but the heart that keeps the blood pumping. And I'm, again, incredibly proud of these, again, amazing professionals. We've got such a depth of knowledge and experience with our client service team. Again, I'm not going to go through each one of them just for time's sakes. But you'll be able to put a name to your face. More than likely, these are the people you're talking to when you need something, whether it's a transfer, an address change, or an update of an email address. These are the amazing people that help support us, again, day in and day out and make it possible. And thank you. Our administrative team that handle scheduling, coordinating events, our front desk receptionists, again, some amazing people that you can go through here on the screen. Just incredibly proud of them and thankful for everything that they do to make it possible in supporting you and all of our amazing advisors. Our affiliated advisors, these are a group of professionals that we partner with that primarily are here in Arizona, but some are not. Rizzo Financial Group has been a partner of ours for more than 17 years. Premier Wealth Management over in Albuquerque joined us about 3 years ago. Triumph Wealth Management, our newest affiliated partner, joined us earlier this year in Miami, Florida. Mosaic Financial Associates, JRS, our partnership down in Tucson, and In Touch Wealth Advisors, another partnership here in Scottsdale. So just want to recognize them and say thank you again for all the support that they provide to their clients and us as a whole. Our business partners, as many of you know, our focus here with our organization was to have a one-stop shop where we can help you in many different areas that you might need financially and or professionally. The team that we have here primarily in Scottsdale, Taylor Watcott, leads our property and casualty division. His primary focus is on helping you with your home and auto insurance. If you own a business, we do a lot of business insurance as well. JD is our college aid planner. Mike Patnell is our longtime CPA, again, been with us for more than 17 years and focuses on tax preparation and tax planning. Casey Taylor, again, a longtime partner focusing on real estate and real estate services, including buying and selling your home and mortgages and qualifying for mortgages and all those things. The Phelps LeClaire Law Firm, who joined us about 5 years ago and is our primary go-to for estate planning documents and needs. And last but not least, Lisa Martin, who is our health insurance expert. We sought out Lisa a couple of years ago because we heard the demand from you, our clients, that we needed more. You needed and wanted a place to go to help you through all of your healthcare planning needs, right? And it's very common for our clients to retire before they get to 65 and need Medicare. And Lisa's here to help with those needs as we can help you shop different health insurance options and make sure we have a good plan in that area. So again, just wanted to say a special thank you to each of our business partners, and also spend a little bit of time to make you aware of the resources that we have for you. If you are needing some consultations in one of these areas, please let us know, let your advisor know, let your client service representative know. We'd be happy to make an introduction. These people and professionals office with us. Most of them are here in our Scottsdale office, and we'd love to make an introduction to you. They've been wonderful partners over the years. So I want to, again, say a special thank you to them. One of my favorite slides, and again, there's so many of our clients that I'm going to start on my right side of this slide, our Wilde for Arizona, our community outreach program. Again, many of you that have been part of our organization for 15, 20 years know how passionate we are about giving back to the community. And we like to share those not only experiences with you, but also some opportunities with you. So, a recap of the first half of this year, Wilde for Arizona tallied $85,000 in scholarship donations that are used for low-income families to attend private school and private school organizations. We had a very successful Phoenix Children's Hospital toy drive. We donated over 100 toys to patients of the Phoenix Children's Hospital and raised more than $1,000 that was given to caregivers for the nurses of PCH. Just a wonderful organization, very successful first half of the year. So thank you for all of you who participated. And again, it's a passion of ours and our responsibility to give back to our community, and we're proud to do it. A few upcoming events, our Q3 charitable organization, we've chosen the Boys and Girls Club. We have two initiatives that we're going to be driving through the third quarter. We have an alumni golf tournament at the end of Q3. If that's something you'd like to participate in, please let us know and we'll get you the information. And a back-to-school shopping spree and fundraiser. On top of that, and it's not on the screen here, but I wanted to share with you, we have about 20 of our employees who have committed to and are going to be donating their time at different Boys and Girls locations around the Valley and helping them staff different needs that they have. Boys and Girls Club is an amazing organization. Many of our team members and advisors have personal experience with the Boys and Girls Club, and we're super excited to be a part of that. Last but not least, our Q4 toy drive is going to be our annual Toys for Tots toy drive. This is something we've done for close to 23 years now, and we're excited to be doing our annual toy drive at the end of the year and benefiting Toys for Tots. Again, we will be sending information out, but if you have any questions, would like to know how to participate in these events, please just give us a call, let your advisor know, and we'll put the right people in touch with you, and we'll be proud to have you help us help our community. So thank you. To the left side of the screen, which equally I'm proud of, Wilde Wealth Management Group and our professionals continue to get recognized nationally. Barron's does an annual report. They call it their top 1,200 financial advisors. We were ranked number 1 in the state of Arizona for 2023. This was our 15th consecutive year being recognized in that Barron's top 1,200, which I'm super proud of. I also would like to say that we are one of only a handful of independent financial planning firms that are on that organization. Most of those recognized financial advisors work for large firms and in many cases are working for organizations. We are one of the only independent. Earlier this year, Barron's also recognized us in what they call their top 100 private wealth management teams. This was our first year in being recognized in this, and it's pretty exclusive. They only pick 100 private wealth management companies around the country. We were ranked number 82 and proud to be on that list for the first time this year. Forbes does an annual Best in State Advisor. We were ranked number 2 in Arizona. This is the 3rd consecutive year with that ranking at Barron's. Cetera, which is not a publication that really deals in the financial press. Cetera is a non-for-profit organization that our partner firm, Cetera Financial Group, has created. And we were recognized with a silver status and a top 3 nominee under Cetera for our investments back into our communities. We were named one of Arizona's most admired companies in the 2nd year in a row by Arizona Business Magazine and voted best places to work by Phoenix Business Journal. And lastly, I already kind of mentioned this, but 2 new team members have joined us this year. Advisor Jonathan Fagan here in our Scottsdale office, and our new advisor partner, Antonio Lopez, joining us in Miami. That's a lot there that I spit out. I just wanted to recap some of the highlights of the year so far. Again, I want to thank you for your participation in today. Again, as I mentioned earlier, my partner, Jeff Anthony, is going to be going through the detail of the discussion today. So without any further ado, I would like to turn the time over to Jeff Anthony and let him take it away. I wish you all a great rest of your summer and look forward to seeing you in the back half of the year. Thank you very much.
Thanks, Trevor, for the introduction, and I appreciate everybody for being here today with our fearless leader giving us our intro. So hope everybody is having a wonderful week so far, and get some good talking points or get some good points out of this as we go through. So my name is Jeff Anthony. I'm a wealth management advisor in our Tempe office. I've been with Wilde Wealth Management for about 5 years now, and very happy. Like I said, it's a great team. Couldn't have a better team as far as like everybody from our clients relation support all the way up to our executive council with Jackie, Trevor, and Janine. So very happy, and again, thank you all so much for taking the time out of your busy schedules. So let's dive right in. One of the biggest things we're going to be talking about is from a high level view is what's going on in the economy right now, both in the economy and the financial market. So more specifically, how this impacts your money. And then also some of the other things that what might be ahead for the rest of the year. So we're going to give you some good insight today, and feel free, if you have any questions after the presentation, feel free to reach out to your advisor. We'd love to give you more commentary around that or context as you need it. So let's get started. So we're going to start today with the economy. The United States has continued to confound many economists and analysts by performing better than expected. One of the biggest things, so when you hear about people talking about the economy, they're going to be using this liftoff or the airplane analogy, so, or jumbo jet, as you can see in the picture. So if you think about the economy as a jumbo jet, when the pandemic ended and the restrictions were lifted in the third quarter of 2020, a lot of people thought that the economy would be parked at the gate. So they call it like a non-liftoff at best, or trading down or kind of fumbling down to the taxiway. But that just wasn't the case, and we've kind of seen that the economy has taken back off after that point, obviously through COVID and everything like that with the stall points and kind of shutting everything down, and then a re-acceleration that we saw the next couple of years after that with all the stimulus and everything. So it's been an interesting kind of last few years. I'm sure the history books when we go through this is going to be very, very interesting kind of looking back from that. So a couple things that we want to kind of piggybacking off that is looking at the United States if the economy was flying. So pandemic stimulus has put a lot of money in people's pockets, as you may know, and they were ready to spend it. That's one of the biggest reasons why we saw a lot of this inflation that we've seen over the past year and a half. So it wasn't a smooth flight, obviously, as you can see from these charts. Sometimes we have better than expected GDP growth, which is going to be our gross domestic product. And you can see it changes quite a bit from quarter to quarter, depending on what's going on in the economy. So real GDP, which is in economic growth after inflation, is in light blue. GDP is in the dark blue. So the dark blue line shows the economy rebounded and then continued to grow after the pandemic. The light blue line shows how inflation affected economic growth in 2022, when the economy contracted after inflation was factored in. Obviously, we had pretty high inflation last year, which spiked up and peaked around June of last year at about 9.2% or 9.1%. The light blue line here shows how inflation affected the economic growth. In the 2022, the economy contracted after inflation was factored in. That spurred the Federal Reserve to take action. In March of 2022, if you can think back about a year and a half now, the Federal Reserve began aggressively raising interest rates, specifically through the federal fund rate, to slow the economic growth and bring inflation down. As this shows, the economic growth has slowly been losing altitude, indicating that the economy may be ready for a landing. And again, when you hear this back and forth from different economists and different news channels, or however you get your information, you'll hear about hard landings and soft landings, which we'll go through later on in the presentation. But we wanted to give you kind of the building blocks on what they're talking about when they're talking about this jumbo jet analogy. So moving over to the last part, getting into restricted territory. So we wanted to kind of put this in perspective, since the Federal Reserve did very aggressively start raising rates. So the Fed guided the U.S. economy to its current state of primarily using the blunt instrument of interest rate changes. So one of the biggest things that the Federal Reserve does is they control basically monetary policy. So, and they do that through two things. They can either flood the markets with cash or restrict it, pull money out of the economy, and they can raise and lower interest rates to affect people's spending habits. So currently, if you look at this chart, from the beginning of 2022, we were at 0%, and they raised it all the way through and actually since this last report has come out, we've had an additional rate increase. So we're sitting somewhere between 5.25% and 5.5% currently. We were sitting at about 5 to 5.5% at the end of the second quarter, which is what is showing on this chart. So kind of looking at this from a historical standpoint, we really haven't seen these levels of federal fund rates. We'd have to go back to the early 2000s, which again, you can see how these things will trickle down into different parts of the economy, which we'll talk about in just a few slides. The main purpose for the reason for the Federal Reserve to be raising interest rates was to cool inflation. Obviously, we saw this coming through, and this will kind of break down a couple different areas. So the aggressive hike has kind of helped cool this down. And here you can see inflation since the pandemic ended. The headline inflation rate, which is in blue, peaked in June of last year and headed lower, so which is a great thing. You can see that peak there up at 9.1%. And then at the end of this, so at the end of the second quarter, it was at 4. The very last reading that we got, we actually saw it tick down all the way down to 3 and then pop back up over the last reading that we got about a week or two ago, up to 3.2%. Now, one of the biggest things that we pay attention to is obviously that old adage, don't fight the Fed. And with this, we think that we're getting closer to the end of this economic hiking cycle. And the Federal Reserve has been pretty good as far as like providing forward guidance on this. They use different things like transitory and items like that. But one of the biggest takeaways that we want to have you take away from this chart is going to be that what the Federal Reserve is doing is working, and it is bringing prices down. I know that most people would like to see prices kind of below where they were pre-pandemic, but this is just showing the pace at which they are growing has slowed down significantly. So again, this is a very important piece because as obviously multiples and things like that, when we're analyzing stock prices and forward earnings, this plays a big role into that because as interest rates are higher, borrowing costs and things like that become more expensive. And it makes it more difficult for the bigger companies like your Fortune 500 companies to continue to grow as far as if they're using lending and leverage from that standpoint. So one of the things we also like to point out is while prices are rising more slowly, rate hikes are not a precision instrument. One of the things that we talked about a few years ago, the Fed kind of got caught up in their words, was this term of transitory. And transitory, again, they didn't really provide a whole lot of broad explanations behind this. And the main reason for that is because transitory, which most people thought was going to be, I don't know, maybe over a 12 to 18 month period. And, from that standpoint, we kept seeing a significant increase kind of going into the first half of last year. And that was one of the main issues. So the Federal Reserve's tools are a bit like the analogy we like to use, like the Wright brothers rudimentary flight controls. When the Fed raises rates from the federal fund rate, other rates tend to move higher. So as the federal fund rate, which you'll see in the dotted blue line on this chart, as it rose, the rates on the 30-year fixed mortgages, auto loans, business loans, personal loans increased as well. So typically when rates rise, the demand for goods and services falls because borrowing becomes more expensive. And that's their tool that they use to kind of slow economic growth and to get control of inflation, very similar to what they did back in the early 1980s. So which is the Fed's goal on this. So a couple little, we found some good quotes from some of our market strategists kind of throughout the industry. And this is from Justin Christoffel and Michael Federicks of BlackRock. The whole recession and the Fed rate hikes is to slow a booming economy and prevent overheating. Against this preposterous backdrop, while the Fed is hiking, businesses and consumers tend to feel confident spending. Ultimately, though, the tighter financial conditions slowly trickle into business decision making and household spending, which often precipitates the pause in hiking. And that's kind of where we're seeing right now. When they raise interest rates, and again, we raised them very, very quickly last year, right? So we had about 4.5% increases last year. And if you recall at the beginning of the year, they were calling for about 0.75 to 1% for the entire year. And obviously we blew way through that. So their whole point behind rate hikes as a blunt tool is that they don't have an immediate effect. They typically take about 12 to 18 months for higher rates to take effect on consumer spending. And that's kind of from where we start pausing the hikes. So we're starting to feel that, and you'll see that through credit card balances. We have the highest interest rates that we've seen in 25 years, 20 to 25 years on credit cards, which we'll go through in a little bit later in some of the later slides on this. But again, and that was the whole point behind the transitory piece. Again, they probably should have raised a little bit quicker to that, but they're making sure that they don't want to have this resurgence of inflation, because that's one of the main issues that they ran back into in the early 1980s under Paul Volcker, which they just don't want to make that same mistake again. So, and kind of how this affects different parts of the markets, we want to go through this. So specifically, we saw this in the bond market last year, but as the rapid Federal Reserve rate hikes happened last year and how they affected bond yields. So the chart shows the federal fund rate in blue and the yield on the 10-year benchmark U.S. Treasury in orange. We experienced a multi-decade bull market in bonds. And in July of 2020, the 10-year yielded less than 1%. So when you look at this, again, that whole TINA trade, so there is no other alternative, that was one of the reasons that was pushing a lot of people into the stock market, especially if you're in your retirement years. Bonds typically over time in this multi-year decade, like the last time rates peaked up in 1981 and then slowly came down over the last 40 years, coming back down through that. So what you got was you're getting yields and then your bonds were also appreciating at the same exact time. But just to kind of put it in contrast for you, how quickly rates have moved. So in that July example, they were at less than 1%. Now they're over 4 as of the last reading. As we're recording this today, the 10-year Treasury is at 4.3%. So it's notable that in the recent months, Treasury rates have not been moving in tandem, though, with the federal fund rate. This suggests that the bond market thought inflation had peaked and economic growth was slowing. The federal funds rate hiking was near an end. So as we start seeing this, you'll see different conditions, and they kind of all loop in together. But one of the biggest things that the Federal Reserve is doing is they're trying to artificially slow things down. But again, they control the front end of the curve. And the midterm, so like when your 10-year treasuries or your 30-year bonds, those are areas that they really can't affect. That's going to be more affected by economic conditions. So when you have these type of things kind of giving and taking, they kind of all massage in together. So next thing I want to go through is reasons they give the Federal Reserve to pause. So the idea that the Fed is ready to pause rate hikes reinforced the March banking crisis. So as you recall, back in March, we had a couple of the regional banks mismanage some of their underlying portfolios. So again, just to kind of give you an idea, when you deposit money into a bank, they have certain lending requirements or depository requirements that they have to keep in cash in your bank. And then what they do is they can lend out the rest of that money. And a lot of the times with rates being so high, the short-term rates, they can, some of these banks are paying you less than 1%. And then they're taking, call it roughly 90% of your money and then putting it in or buying 10-year or 3-month treasury bills that are paying, 5% plus. And that's kind of where they're making that spread there. So with the rapid rise in federal fund rates and the corresponding rise in the 10-year treasuries, rates contributed to the banking crisis. So in that equation, we were telling you about that the banks, going back to July of 2022, the 10-year treasuries were yielding less than 1%. They had to keep on going out onto the yield curve to try to pick up more interest from there. And that's what basically caught them. So when interest rates rose, so specifically, some of the banks chose those longer dated maturities when they were purchased, when rates were ultra low. And then, I don't know if you know this, but you know what happens when the value of bonds, when rates rise? They have an inverse correlation. So the value of the bond falls when rates rise. If you hold them to maturity, you can expect to receive a return of principal. But one of the U.S. banks went to go sell their bonds before maturity to raise cash to help depositors. And this concerned depositors, and then coincidentally, there was a run on the bank. The Federal Reserve and the U.S. Treasury acted quickly to step in and support the banks and provide liquidity. However, like because of this situation, it does cause banks to become more conservative because they don't want to be the next person that's in line with having any runs on the bank or running into any liquidity issues. So bank lending centers in turn tend to tighten up, making loans more expensive and harder to get. So this should cool business spending and help slow economic growth, moving us closer to that economic landing that we will go through and the different landing conditions there. So just wanted to give you a little bit of background on that, just to give you some insight if you weren't aware of what kind of went on with some of those banking crises. So what I want to go through with you though, which I find when you're listening to the news, they go through these different scenarios. So you'll have no landing, soft landing, hard landing, and we want to give you context about what those mean. So, and there's different scenarios, right? So the soft landing and hard landing, these are going to be different variables that we just don't know are going to play out. Things like, the war in Russia and Ukraine, tensions between China and Taiwan. So all of these things, we don't know what the outcome is going to be. Energy prices, things like that. So if there is a soft landing, we want to kind of put some context behind each one of these. If there's a soft landing here on the left-hand side, economic growth will slow and inflation will drop. There's no recession and the Fed hold rates steady. So it may eventually lower rates to support stronger economic growth. So that's kind of a best case scenario for us. So when you're looking at this basically very similar to what we're seeing right now is you don't have hyper growth here from here. You're kind of muddling through the mud, but you also don't have to go through the pains of, a hard landing is going to be, you have layoffs and things like that. So on the right-hand side, if we have a hard landing, the economy will contract, and that usually means that something broke, right? So the hard landing is not a great scenario. There will be a recession, although we believe that it's going to be more mild just due to the fact that unemployment sitting at about 3.5%. So it's hard for the economy to have a significant recession or a harder recession when everybody's working. So typically the Federal Fund lowers rates pretty quickly during a recession to encourage a kind of jumpstart the economy. So we wanted to kind of put the context behind both of those. When you hear those, we want to kind of explain what those mean for you. So there's mixed data on both sides of this. So is the economy ready to land? It's possible that the US economy isn't ready to land yet. Throughout the year, the economic data has been mixed. So you'll see this on different economics strategists. When they give their forecasts, it's been a wide variation between everybody, which has been pretty interesting. I haven't seen this, and kind of even talking to some of my colleagues that have been in the industry quite a bit longer than I have. It's very uncommon that this type of scenario happens. And again, there's different phenomena that kind of play into that. But while it appears that inflation has peaked in the US, the strength of the economic data and comments from the Fed officials suggest that getting the Fed's target may require rates to remain higher for longer. The labor rates have shown remarkable resilience, and unemployment as of the end of June was at 3.6. We've actually stepped down from there down to 3.5. And wage growth, which contributes to inflation, slowed in May before rising in June. The number of jobs available declined in May, and the number of layoffs, quits, and separations remained unchanged from April to May. This is some of the evidence that employers are hoarding employees because they cannot find enough workers. So, if you're looking at this, historically, if unemployment's at more like the average inflation, so technically when you have full employment, that's at 4.5%. And with that, because there's such a lack of supply, like right now, the job openings report that tracks how many jobs are open in the US is sitting at about 9.6 million jobs. And with the labor markets being as tight, a lot of companies are actually seeing this. They don't want to lay people off just to kind of help with their bottom lines if they're slowing down a little bit, because the cost of hiring somebody on and finding somebody that they could work is so much higher. So that's kind of one of the frozen markets that we're looking at right now. And then the other piece, as far as like on the manufacturing side, global and US, we've seen some contraction. So labor signals are mixed, and so are the messages that are coming from the S&P Global Purchasing Manager Indices. The index measures month-over-month change in economic activity. The June report showed manufacturing conditions contracting globally and in the US. In a tweet from S&P Global, reported manufacturing conditions worsened globally, and the PMI fell to a 6-month low of 48.8 in June. The reason why that 48.8 is important, anytime when we measure the economy, we call this a heat map. If kind of your zero line is going to be right at 50, so if that PMI number is above 50, that means that signals that the economy is actually growing and expanding. If it's below 50, that means the economy is contracting and typically means that there's some economic headwinds or recessionary conditions. So the steepening contraction in new orders fueled the downturn. Moreover, the output fell for the first time in 5 months. In the US, declining factory orders were instrumental in decline in manufacturing. So we like to put this up just to kind of give you, this is one, like a very macro view of everything, but it kind of gives you how everything kind of blends together. While manufacturing contracted in the US, the service sector expanded with the index at 54.4. So one of the areas, and we'll go through some of the inflationary pieces here, but the US services expansion was supported by strong client demand and new business gains. The JP Morgan Global Composite Output Index on the right reflects manufacturing services combined. Global private sector cooled in June and the PMI at a 4-month low at 52.7. So remember that 50 is kind of our bench line, growth versus contraction. The slowdown resulted from a softer expansion in activity at services providers and contraction in manufacturing production. So another important economic indicator is housing, which obviously in Arizona, we've seen this kind of, if you've been here for a longer period of time, has been pretty volatile, kind of going back, even if you look at it over the last 30 years. So with housing, and the market appears to be in the early stages of a recovery. So we do think that we've probably been somewhere close to a bottom here. So in early July, Barron's reported the nascent recovery in the housing market becomes sooner than expected, given that mortgage rates have more than doubled in the past year and a half, and homeowners who locked in record low rates in the pandemic are now reluctant to sell. And that is squeezing the nation's supply of single-family homes at the same time at a wave of millennial first-time home buyers, buoyed a strong wage growth and healthy household savings looking to put down roots. So one of the issues that we're having here is, about 80% of the mortgages that we have in the industry right now are sub 4%. And if you look at that, and now rates as of today are probably around somewhere between 7.5%, give or take, and that's on a 30-year fixed. If you're looking to either get a bigger house or downsize or just move in general, most people don't want to pay an extra $1,000 a month if you're looking to even if you make a lateral move, just because of the interest rate environment. So we have this divergence where, obviously higher lending costs have caused the building side of this to slow down quite a bit. So when you're looking at some of the home builders and things like that, that has slowed things down. But then you also see this other piece of it where people that have these lower interest rates on their mortgages just don't want to move because, again, why would you move and have to pay a mortgage payment that could be up to 50% more? So that's one of the biggest things that we've been looking at on the housing market, is just from that standpoint. But that has caused a lot of support on this, and the reason why, because if you looked at this a year and a half ago when rates were at 3 and we told you that rates were going to be at 7.5, you would think that the outcome would have been a lot worse than we're currently sitting at today. So next thing I want to talk about is stagflation. If the economy isn't ready to land, so again, kind of looking at both of those scenarios, we may see a period of slow economic growth and higher than desired inflation. One name for this economic holding pattern is stagflation. So typically it features slow economic growth, inflation that's above the Fed's target, steady consumer demand, and continual Fed rate hikes. So that's similar to what we've been going through right now. Eventually, rate hikes dampen consumer demand, which we talked about, that 12 to 18 month time horizon. Higher for longer rates are also likely to affect investor sentiment and financial markets. So again, the cost of borrowing and all these type of things will trickle down into the economy. Your money just doesn't go as far because, again, a lot of the times when you're purchasing, whether it's vehicles, homes, whatever it may be, if those payments are a lot larger of your disposable income, it just gives you less discretionary money that flows into the rest of the economy. So now that we talked about the economy, I want to go through obviously the bulls and bears case and financial market. So the last was kind of the economic view of this. This is going to get more into the how it affects the portfolios and how we see things affecting the markets. So one of the things we like to point out, this is a cool chart we thought that was pretty interesting. So we reached a trough in the S&P last year. It was roughly about October 12th, October 13th. So the Standard & Poor's Index entered a bull market in June as investors climbed out of a wall of worry. And the wall of worry is an obstacle or a set of obstacles that investors face, right? So you have to climb this wall of worry. This year, this wall reached a considerable height as inflation, war in Ukraine, U.S. tensions, slower earnings growth, and a high cost of residential real estate, low demand for commercial real estate, and tightening credit conditions, and other issues that weighed on investor confidence and investor sentiment. This wall is not as tall as it once was, right? So if you look back at this 6 months ago, or even going back to October of last year, there was a lot of negativity and there's a lot of headwinds that we had in the market. So some of those things have dissipated from there, and we didn't get a lot of positive news last year, and rightfully so. I mean, we're correcting. Recessions and bear markets and things like that typically happen every 5 years. So, but one of the things that we saw this year, so this wall of worry, not that we haven't had a fair share of stuff this year so far, but that wall is not as tall as it once was. Like the banking crisis calmed from where we saw in February. The Federal Reserve might be pausing interest rates, which last year, if you kind of look at this from a compare and contrast, we had no stopping case. So it was one of those things where they were just going to continue to raise rates. We just didn't know how high they were going to go. The Federal Reserve may pause rates, like I said, and then it was enough to boost investor optimism and cause a rally that lifted the S&P 20% from its lows in 2022. So again, when you have this abundance of worry, a lot of the times, and we've seen this historically, when sentiment gets so negative, you actually typically see a boost up on the other side. This is another very interesting chart that I found pretty helpful. So the good news is that once stocks are up 20% off from their lows, research showed that continuing strength is quite normal. In fact, since 1956, the S&P has been higher 12 times and up a very impressive 17.7% on average 1 year after a 20% bounce. The only time stock markets were down during this vicious early 2000 tech bubble, which I'm sure a bunch of you remember. Taking it one step further, new lows were made after the market rose 20% only 3 times, while lows held 10 times. Research found that on 2 occasions, both during the tech bubble and when stocks gained 20% and again moved to new highs, it was also happened during the global financial crisis of 2007 through 2009. Fortunately, conditions are not all similar now to those very bleak times. So again, financial crisis going back with that, we had a break in the financial system. We had a lot of fraud going through the economy. Right now, basically, we have a lot of dollars that, again, were pumped into the economy during that COVID, chasing very few products and services, right? So as that starts to work through, that's one of the things that's been calming things down. We haven't seen too many things break like we did back then. So kind of piggybacking off the last slide too, because we want to give you some historical context around this. So when the stock market gets off to a good start, it tends to have a pretty good year. Since 1950, the S&P's median return in the blue bar for the final 6 months of the year have been 5%. The right-hand side of the horizontal axis shows the return for the S&P 500 during the first 6 months of the year, so 0 to 5%, 5 to 10%, so on and so forth. When the stocks have risen 10 to 15% by the end of June, the final 6 months of the seen markets move higher 12 out of 12 times. So again, not everything's always the same, and they've gained close to 11%. So when they have risen 15%, they have moved higher 66.7% of the time. So when we look at that again, we look at, we kind of use the past as a guiding force, or kind of looking at things how they've played out in the past, and kind of use that as, again, one of the metrics that we look at when we're making our investment thesis moving forward. So pretty interesting data. And if you'd like to dive into more of this, like I said, feel free to reach out to your advisor. A lot of great information here. So this has also been a pretty big phenomenon that we've seen recently, right? So If you looked at this and they talk about this, the Magnificent Seven, so we all know what those are. Those are going to be the big tech stocks that we've seen. One of the issues that we've seen kind of this year is typically when you have a rebound, you need a pretty good breadth of the market, meaning that we don't want to see 7 or 10 stocks leading the entire market. We want to kind of see, the broad base of this and all of the companies in the S&P 500 going on. So early on, gains were driven this year by a handful of stocks, like I said, the Magnificent Seven, while the majority of the indexes lagged. The performance gap had some investors questioning whether the markets were less resilient than it appeared to be. Others thought it was going to be a matter of time before weak gains became more widespread. And as we're in the markets in the United States, then the S&P 500 advanced decline line closed in all new highs. The bullish signal that sent the trend higher is indeed higher. So what that basically means when we're looking at this, we want to make sure like we started to see this breakout, and you can kind of see this as the rest of the market started lifting. We didn't necessarily think, and again, the technology side of the portfolios have come through pretty quickly. And it's not one of those things where we expect them to fall back down, but the rest of the markets to catch back up. And that's kind of what we're seeing right now. So we follow these, and this is more on the technical side. So the advanced decline line is a cumulative daily tally of the stocks that go up versus the stocks that go down each day. When it makes a new high, it is a sign that overall market breadth, the number of stocks gaining during a rally, is quite strong. In general, breadth tends to lead price, so that's very important. At major market peaks, we tend to see stocks make new highs while breadth weakens. Today, we see breadth making new highs, and price hasn't yet. The key word is being yet. Prices will eventually make new highs, although breadth, just as it's done many times throughout history, and there's a good chance it will happen this year. So we kind of like to give you some context behind some of the stuff that we're looking at. We found this was pretty funny. So we like to bring in a little bit of humor for this. So I want to go through this cartoon. So if you look on the left side, it says the dorm. It's kind of going through somebody in college. So you can see on the left-hand side, dude that bites. And then, oh no, my dog ate my AI-written essay. So pretty funny. The reason why we bring this up is because obviously with the artificial intelligence boom that we've seen so far this year, we want to kind of give you context around this and give you examples of how this is not just going to be on the technology side, but kind of how it goes through all the different sectors in our economy. So many expect artificial intelligence to profoundly change the way that global businesses operate, very similar to kind of how we saw the internet boom of in the 90s. We have seen a rally in information technology and communication services. You'll see that on the left-hand side, the sectors this year. However, AI is expected to affect industries and companies far more broadly. When you look at this, think of like trucking. There's multiple different things, examples that we can go into this. So with new technologies that arrive like this, it can disrupt the world as we know and lead to melt up in the market. So a melt up, what that is, happens when the markets rise unexpectedly due to investor enthusiasm for the innovation. Excitement around AI was apparent when companies reported the first quarter earnings too. A higher number of companies mentioned AI, generative AI, than they ever had before. So that was kind of that big, right after we saw the banking crisis or the mini banking crisis that we saw going back in February. You'll see in March, I think it was a couple weeks later, that's when that ChatGPT was launched, and then a lot of companies started releasing their own AI. And that's what really caused that market sentiment to really quickly change and kind of shift directions on where people were focused at that time. So this chart, again, when we're looking at things that are on the deflationary side, obviously you have your capital expenditures, which is expensive, right? So you have to build in these new technologies, but ultimately they create efficiencies in the market, which efficiencies, as we know, just like how we did outsourcing over the last 30, 40 years, that's going to help costs come down. And then as you see that, again, the efficiencies come up and just help us kind of keep costs in a range-bound area. So next thing I want to talk about is the fourth quarter earnings decline. And really the big thing that I want to show you on this is a lot of our clients ask, we see that the economy is doing this, but the stock market is doing this. So I wanted to provide some, just some context around this. So first quarter's earnings season was better than expected, and better than expected from the expectations of Wall Street. So while earnings from companies on the Standard & Poor's 500 index declined overall, they did better than analysts expected. So 78% of the companies in the S&P 500 reported better than expected. So that number was higher than the 10-year average, and so was the magnitude of the earnings surprise. So 8 of the 11 sectors experienced year-over-year revenue growth, and 3 saw revenue decline. The revenue decline was in IT, energy, and materials. The blended net profit margins for the first quarter of the S&P was 11.5. That was higher than the previous quarter net profit margin, which was 11.3, and below last year's first quarter profit margins of 12.2. My whole point to this is, again, things didn't pan out as bad as they thought. Earnings declined. And the reason why we also saw a tick up in the market, you can see they declined 2% year over year. But when we were looking at this, the expectation was markets were going to be down 7%. So when you look at it from an economic standpoint, that's not a great thing, right? You see contraction, you see things shrinking. But on the other end of it, when you have the way the analysts set their expectations, if it's better than what they come in, regardless if it's negative, same kind of thing with inflation, that tends to be very favorable for the markets. So getting down to Jerome Powell. So this is, if you're not familiar, this is the head of the Federal Reserve. So a very popular guy right now, especially with everything that's going on. One factor that has greatly influenced the stock market, as we've seen over the last 18 months, the performance of the stock market is the expectation that the Fed will pivot. And what that means, meaning that they will stop raising interest rates and begin to lower them. Many investors believe that the pause in rates or a reversal in the Fed policy will boost corporate profits. The thinking behind this goes into something like this. Higher rates usually hurt corporate profits because borrowing becomes more expensive. Think about this in your personal life. And companies often choose to spend less. So if, again, you take out a higher mortgage or you buy a car and that car payment today or house payment today is 50% higher than it was a year and a half ago, you have less money to spend, kind of spread that out because you're going to have a finite amount of cash. So this limits the amount of growth and profitability. So if rate hikes stop or rates decline, then corporate profits then in turn should get a boost and stocks will gain. So since investors look ahead, 6 to 9 months, current stock market levels reflect investors' expectation that the Fed will pivot. However, the Federal Reserve officials have been quite clear that they anticipate more rate hikes in 2023. So since this came out, like I was showing you, we've had one more. We anticipate that they're more than likely maybe one more in September, and then they're going to hold there because we're in that restrictive area that they want to wait and see how things are going, and they still want to try to get below that 2% target. Although we think that's going to be a little bit more difficult just because of the housing market. So this is a good quote that we found from one of the investment officers over at Bridgewater. So Greg Jensen of Bridgewater told Bloomberg, the Fed seems a little bit more realistic than the markets do on what it's going to take. To get an equity rally from here, you have to have lower rates fairly quickly into a world where earnings seem pretty good. So the whole reason we brought this up is the Fed's been very clear on what their intentions are, and sometimes, especially, we saw a pretty big divergence on this year. A lot of the economists, it was kind of a split camp, right? Half the camp was saying that they were going to lower rates by the end of this year. The other half was saying that they're going to keep them steady and or raise them a little bit. So just from kind of where we see the forward guidance being right now, as long as nothing breaks, that they're probably going to be holding their rates here high, at least holding them, possibly 1 or 2 more rate hikes this year. We think probably more than likely it'll be 1. And then holding from here and seeing how economic conditions hold from there. So we're not going to go through the same period that we went through last year. The money supply contracting. So this gets a lot of publicity. So we want to give you some context behind this because, again, this is something that we watch pretty closely. But you got to remember, this is all about perspective. So the Federal Reserve has been engaged in quantitative tightening. What quantitative tightening is the shrinking of the money supply in the United States. So the U.S. money supply is measured in 2 ways. So M1 includes cash, coins, and checking accounts. Pretty much anything can be spent. M2 is M1 plus savings accounts, money market funds, and certificate of deposit. I'm going to share a really ugly piece of data. This tweet was from Nick Gerley of the Revenuture Consulting. He points out that the U.S. money supply has shrunk by 2%. That's a pretty rare occurrence. Since 1870, the M2 has declined by 2% year over year on 5 occasions. So 4 times between 1870 and 1933 and today. So prior events have led to 3 depressions and a bank panic. So while that could be the case for concern, it may not need to be. And this is where we want to kind of provide context around this. The reason is pretty straightforward in our view. The money supply was supercharged during the pandemic, obviously through PPP and all those other programs that we had. So all the stimulus packages that we had and other financial supportive programs. It grew the money supply by 267% in a single year, in the biggest expansion of M2 in 153 years. In the past, contraction of the money supply was not preceded by any exceptional expansion of the money supply. In fact, it's clear that consumer spending has remained strong despite inflation and the money supply contracting. So again, we're just burning through a lot of this excess that we've gotten. And when we had these contractions before, again, we've never had the magnitude of which they pumped money into the economy. So in May, San Francisco Fed Reserve estimated that pandemic stimulus, including stimulus checks, PPPs, this kind of paybacks off the last side, and expanded unemployment benefits, helped Americans accumulate excess savings of $2.1 trillion through August of 2021. So far through this session, you can kind of see this kind of drawing down. The savings drawdown from that $2.1 trillion was 1.6, and actually some of the readings that we've gotten is that that savings has actually been completely depleted now. So again, the chart shows that economic growth over the last 3.5 years, including COVID-19 pullbacks and subsequent recovery, 4 major categories contribute to economic growth, and the primary contributor is consumer spending. So if you look at GDP spending, GDP reporting, 2/3 of GDP is solely dependent on consumer consumption. So if the consumer stopped spending, that becomes a very big issue in our economy because we're more of a consumer-driven economy as opposed to like a China that's more export-driven. So it's clear that the consumer has remained strong over the past year, which is the reason why the markets and the economy has been fairly resilient. And in fact, consumer indicators have been strong through this year, stronger than where they were late of 2022. So we're experiencing a market rally, but people have a very different opinions on the staying power of whether this is going to be a sustainable rally or something that's going to be fading here in the second half of the year. So when we look at this, we took a survey. Well, actually, CNBC took a survey, and they polled about 400 chief investment officers, equity strategists, portfolio managers, and other people that manage money. The majority, 61%, agreed that we're in a bull market. Almost 2/3 were confident that we're experiencing a bear market rally, meaning that we've reached a low, we pop back up, and that we're going to retest the lows that we had before. So those are the difference between that's kind of what a bear market rally is. So it's interesting because it's been a very long time, and I don't even know if we've seen the dispersions between this on, both sides of the aisle, right? The bulls versus the bears. So when we're looking at this, that's the reason when you're looking at a lot of the news cycles or news that's coming out, you'll see both sides of the aisle coming on almost every single report. So one of the things we like to look at is just sentiment in the markets, okay? So many investors look to consumer and investor sentiment for insights about where the markets may be headed. And we got some pretty cool charts on this. So on the left-hand side of the table shows consumer sentiment. It dropped quite low in May, falling to 59.2 before rising again in June. Some analysts have said that when the consumer sentiment dropped below 59, it's a buying signal. So again, there's multiple different theories and processes behind this. The right side of the table shows the AAII Investor Sentiment Survey, which many think to be a contrarian indicator. Investors were bearish for most of the first 6 months of 2023. Then in June, bullishness rose sharply. That typically, and you can see that on the table over here, right? So obviously, as the markets continue to pick up and you see that reversal in a downturn trend compared to an upturn trend, more people tend to jump on that rally as time goes on. So you can see this, the bullish versus the bearish, and you'll see them kind of bypassing back and forth there. But as this year's been going on, you'll see that's been increasing. So the Case-Shiller. Sentiment, enthusiasm for AI, and expectations around the Fed may pause rates soon have helped keep the price to earnings ratios at a lofty level. PEs ratios tell us how much investors are willing to pay for each dollar of earnings. So it's basically the price that you're paying today for future revenue flow. So the Shiller-Cape ratio calculates PE using the average inflation adjustment earnings from the previous 10 years, okay? At the end of the second quarter, the PE ratio was 31.1. Historical average is 17.03. So again, on this, when we're looking at the valuations, it remained lofty. If you pull out, though, basically the NASDAQ out of this, we're trading somewhere around that 17% area. So I know it seems a little bit lofty right now, but we know what's kind of driving that forward is really that tech sector, and it's really those 7 stocks that we spoke about previously in the presentation. So next thing we want to jump into is bond investing. So while stocks have remained, the stock markets have delivered some attractive gains this year, it has been a turbulent year for the bond market just because of obviously the bond market really prices in risk, right, in the economy. So the Fed pushed rates higher. Then the banking crisis sent rates lower as investors fled to perceived safe havens. So typically, people go into safer assets like bonds. And again, a bond in simple terms is it's just a loan. So you're lending money out to corporations, governments, and their agencies. So you become the bank at this point, and then they pay you interest. So then we had the debt ceiling standoff, which puts rates higher again, because again, if there's uncertainty in the markets, rates go up because you have to be compensated for lending your money out. So it's a little surprised that the volatility in the bond market, which reflects uncertainty about the direction of interest rates, was up this year. This chart shows the 10-year Treasury yield along with yields on investment grade and BBB corporate debt bonds and high yield bonds. So we follow this chart pretty closely just because as spreads, you can see like during the financial crisis, when you see that big pop up there, that means that deficiencies or delinquencies are going way up. And that's when you have a major market meltdown. So as we saw, that's when, back in 2008, the markets pulled back 51%. So yield curve inversion. So this is one of the indicators that some strategists use as a forward-looking indicator on the economy. So I know that you probably heard about this. They talked about it. It's fading a little bit more. But for most of this year, shorter maturity treasury yields, meaning that treasuries are money that you can lend to the government. They pay you interest on it. Shorter term are going to be anywhere between like 2 years and under. Have yield more interest than longer dated maturity bonds. So to give you an example of that, like 2-year treasuries are paying 5%, 10-year treasuries right now are paying 4.3%. So it's an unusual state of affairs because investors usually want to earn higher yields the longer periods they put their money out. When yields on the shorter maturity treasuries are higher than the yields on the longer term treasury, we say the yield curve is inverted. So typically, a normal yield curve looks like this. It's an upward sloping line. Right now, it looks closer to this. It's flat to slightly negative. So this chart shows the difference between yields of the 2-year treasury and the 10-year treasury. In normal times, the 10-year treasury yield would be more than the 2-year treasuries, and the difference or spread would be positive. Right now, it's negative. Yield inversions have foreshadowed previous recessions. However, the Cleveland Fed Reserve cautioned while yield curves contain important information from the business cycle analysis, it has not always been an accurate predictor of economic recessions. So like if we look at this, the gap between this, like over the last 8 times that we've seen market inversions, there's been recessions that follow every single one, but the time frame in which they happen is anywhere from 6 months all the way to 30 months. So that wide gap, and again, the introduction of modern monetary theory, our monetary policy that we did after the 2008 crisis, again, makes it a little bit different than we've seen in previous market cycles. Wanted to and this is kind of bringing us back to the stock side of the portfolio. Wanted to give you a broad, so each of these one index, I'm going to kind of touch on each one of them individually. The very top one is the S&P 500. So that's the 500 largest companies in the U.S. You can see on a year-to-date basis up 16.9%. We've fallen a little bit from that. This is going to be as of the end of June 30th. But great, excellent start to the year. And again, from where we saw things going, this is kind of unexpected from where a lot of the consensus was at the beginning of the year. Next one is the All World Index. I guess goes through like the 3,000 largest companies in the world, up 13.9. The one below it is EFA. That's going to be your European exposure. The one below that is emerging markets, up 4.9%. That's going to include China, and China's had a very rough go at it. We've seen them having to start devaluing their currency. Their exports are down, so they're going through a very rough period. The Russell 2000 is the 2,000 smallest companies in the U.S., up 8.1. The bond market, again, is up 2.1%. Had a very rough year on record. Last year was down about 11%, which was, almost a outlying year. That was the worst year on record since George Washington was president. So pretty interesting. And then you can see the large cap growth. Obviously, that's going to be led mostly by the technology side. And the one at the bottom that I thought was pretty interesting was the divergence between value stocks and growth stocks on the large cap side. We have a 23% difference, 23.9% difference now. So typically you have these mean reversions that happen. Again, last year, technology was down 35%. This year it's up, over 40%. So you see that big whipsawing where the value side was pretty stable last year. And so that divergence on a year-to-date basis is probably just a lot of the mean reversion that's going on. So what I want to go through next is what might lie ahead. So we went through and reviewed kind of where we've been for the first half of the year. I want to talk about where we see the latter half of the year going, and then also into 24, 25. So one of the big catalysts that we see kind of moving forward with, it's going to be one, not only a big transformation for the economy, but will also change our lives, is some of these topics that we've seen, just how it affects us from the AI standpoint. So top tech trends in 2023, immortality for sale. So tech companies are taking advantage of more powerful AI tools to use the ability to analyze and manipulate genetics with an eye towards selling longevity. This is seen through a lot of this that we've seen on like if you're familiar with Kathy Woods and different things like that, going into this very bleeding edge technology where they're using all of this data. They're able to compile data very quickly and analyze it. And with that aggregation, they're able to come up with faster solutions and better solutions. So some of this stuff that we like to give you examples of this may focus on cellular processes, regenerating body parts, anti-aging supplements, and other goods and services designed to expand lifespans. The next one, digitalification. Surveys found that scents have a powerful influence on our brains. Some technology companies are working on ways to digitally identify, recreate, and transmit scents. This could help doctors identify diseases, people assess out of the freshness of food, and gaming companies offer an immersive smell-o-vision experiences. So very unique, cutting-edge stuff. The super app domination. Many tech companies developing super apps that combine online activities such as e-commerce, social media, transactions, authentications, and more. The idea that the consumers will love their super apps and develop loyalty with them. So these are just kind of some of the ideas kind of moving forward. And then virtual power plants. So these are decentralized energy systems that cobble together diverse energy sources like solar panels, large capacity batteries, wind farms, other sources like that, and use cloud-based systems and AI tools to send energy where it's needed. So some pretty cool stuff there. So growth by projections by region. So this will kind of give you the GDP growth kind of the global landscape. So one of the biggest things I want you to take away from this is they do see global GDP, although it's not crazy off the charts and it's probably subprime compared to what we're kind of used to, especially if you look at this in the United States. One of the things that we're looking at is, yes, we're going to probably have slower growth moving forward, but it's not going backwards. And that's a very important piece that I want you to draw from this is if you start having negative GDP and then higher inflation, that's a bad recipe. And again, it's just not one of those things. We're seeing a slowdown here, and rightfully so. Again, we have monetary tightening, all these things that we talked about in the previous slides. But again, and this is stuff that we get from the IMF, this is showing us that the global growth here is positive. This is a fun one. So we get questions about this, and I'm sure, how the heck do we afford all the debt that we have? So I want to kind of go through some of this and put a little bit of context around it. So in the US, many of the people are concerned that the size of our national debt could affect economic growth. So a lot of people talk about Japan and things like that going back into the 80s and 90s. So, and the debt has been growing pretty rapidly here for obvious reasons. From the end of 2019 through the end of 2022, the U.S. government debt has increased by 35% to 31 trillion. That's an increase of about 8.2 trillion. We know what that's from all the COVID spending. So the national debt, when we're looking at this as a point of clarification, just so to give you the definition of it, the national debt is the accumulation of all annual deficits. The U.S. government typically runs at a deficit each year, meaning it spends more money than it takes in. Now, again, this is the only entity that can run like this. If we ran our personal lives like this, you'd probably not have a good outcome. So this means, so when the U.S. government typically spends more than it does every year, just spending more than it takes in, you add up all of the deficits and subtract the very rare surplus, you'll have a national debt. So that kind of gives you an idea of when you hear about the national debt, what they're talking about. All right, so piggybacking on the national debt, we wanted to provide how that debt is broken down and who owns that debt. So there's basically two types of borrowers. You have publicly held debt, which is 78%, 24.6 billion. This includes treasury securities sold to investors like you and I at home and abroad. One of the biggest owners of public debt is the Federal Reserve System, which holds 20% of the publicly held national debt, according to Pew Research. Publicly held debt has grown by 106% since 2013. 22% is intragovernmental debt, 6.9 trillion. The U.S. government owes this money to the federal trust, funds, and accounts. One of the government's biggest creditors is the Social Security system. Intergovernment debt has grown by 40% since 2013. So this gives you a good breakdown on who's holding our debt and things like that. So interesting fact on this, and we got this from the Brookings Institute, government debt declined between 2020 and 2022 by nearly 65% of countries, including more than 70% of advanced economies and 60% of emerging market economies. So think Brazil, Russia, India, China. Strong growth since high inflation have played key roles in reducing debt to GDP since 2020. Rapid growth and high inflation improve nominal incomes and are subject to taxation. There are two ways to adjust debt, austerity and lowering spending, or more growth. So you can either be very strict and spend less, or you got to grow through all the spending, right? So you use leverage for higher growth rates. So in the US, we benefited from strong economic growth. On the left-hand chart shows that the debt to GDP ratio in the US jumped from 108% before the pandemic to 120% at the end of 2022. The only solace is that if it's fallen from 135% in the second quarter of 2020, primarily because GDP increased by 4.4 trillion since then. Note that the denominator in the ratio is nominal GDP. Example like for that is it's not inflation adjusted. Nominal GDP has been increasingly rapidly over the past few years thanks to inflation, rising 12% in 2021 and 7% in 2022. So one way which GDP or debt to GDP can fall with higher inflation. Here's the thing though. Looking at debt to GDP is sort of like calculating your mortgage balance to income ratio. Using the higher average mortgage, so I'm going to give you an example here, $346,000 as of September 2021. The median household income was $71,000, and the average household's debt to income ratio would be about 500%. It's not a very useful way of determining whether the family can afford the house. As to whether the government can afford its debt, the government's income is not GDP, its income is tax receipts. So what really matters in determining the government's ability to pay its debts is the interest rates and tax receipts. Of course, the Fed has to be aggressively raising interest rates to bring inflation down. Higher rates means interest costs for the government, which is the middle chart you'll see here. Interest payments on the federal debt rose significantly from the end of the pandemic through the first quarter of the year, and so did tax receipts. As on the right-hand side of the chart, you can see that over there. The tax receipts increased thanks to rising asset prices. In 2022, tax receipts were helped as 4.8 million people gained jobs. So all of these things working, obviously home values and things like that create more taxes, and that's going to just be more money that we're paying into the government to help offset some of this US debt. All right. So next thing we're going to go over is interest costs as a percentage of tax receipts have moved higher over the past few quarters. At the end of last year, government interest costs as a percentage of the tax receipts was about 26.6%. The costs increased during the first 3 months of this year, but remains near historical averages, which is about 27%, well below its previous highs. Ultimately, the economy is growing. The debt to GDP ratio should remain stable or fall, and the tax receipts will continue to rise. So what we think, or what the experts think. So what we do here is we like to pull from just some of the industry leaders. The first one's going to be from legendary investor Stanley Druckenmiller, as he sees potential in artificial intelligence. So what he had to say, they haven't separated the wheat from the chaff yet, but I do believe, unlike crypto, that AI is real and it can be as transformative as the internet. And I tend to believe him. I mean, he's very, very smart. They change their ideas weekly, it seems like. But you know, with this, the internet took some time to gain traction. And if you look at this now, I mean, they call them smartphones, but what you have in your pocket right now is really a supercomputer that you can also make phone calls on. So when we look at this, we think this is going to be one of the next waves on this. So I think that that's pretty insightful on his group. The next one, this is again from one of the market strategists from Carson Groups. They help us develop some of the slides. Nearly every strategist in economic told us the same thing. The economy headed for a recession and stocks were going to crash during the first half of the year. As General Patton told us, if everyone thinks alike, then somebody isn't thinking. The consumer remains extremely strong, employment solid, and the housing is showing real signs of bottoming. We've been in a lonely camp that we've avoided a recession in 2023, and others are starting to come around with this realization. Lastly, stocks lead the economy, and we think that indeed suggesting that better economic times are coming. So we like to provide, and this is kind of getting back to one of the other things we were talking about, the divergence between different trains of thoughts or different outlooks has been pretty significant this year. Lizanne Sanders, so she's a managing director at Charles Schwab. I actually really like this one. So she said, one of the theses about the rolling recession is the best case scenario is not really a soft landing in a traditional sense, but a continuation of the roll through such that at some point the services might start to hit. You're seeing some cracks there, or the labor market get hit. So you've got some offsetting stability and strength in other areas. So basically this rolling recession that she's talking about is, you know, we started this from the tech layoffs. You saw that bled into the stock market. Then you'll see it going into the housing market as they started raising rates, bond markets, things like that. But not everything got hit at once. It was like these pockets, this rolling recession. So as one thing was down, the consumer kept us elevated at that point. So I thought this was pretty insightful. And again, we've been using this quite a bit, this rolling recession analogy. This is one of the strategists over at Morgan Stanley, pretty well known because he did a good job at forecasting what happened this year. And this is kind of one of the bear cases. So we will see in the near term, risk reward as lousy. But if we look out to 24 and 25, this is what people are getting excited about. We see capital expenditure boom from reshoring, again, one of the things we talked about, green energy, traditional energy, refitting buildings, and now AI. So this is exciting. The problem is that there is a cost first and then productivity benefit. So you have this large capital investment that you have to put into this to automate things. But that's one of the biggest things. I mean, he's been pretty conservative this year and the markets have rallied. And again, it's like one of those things where made a great call last year. This year it's been a little bit lagging because they were worried that the markets were going to take a little bit more of a hit, which ended up not happening. So one last one. This one's from Mark Zandi. He is the chief economist at Moody's Analyst. So he says, what recession? The consensus that the recession was virtually a slam dunk looks increasingly off base. Yes, there will eventually be one, but odds that a downturn is dead ahead are receding. There's a bunch of reasons why the economy is hanging tough. Here are my top three. First, excess savings. Second, labor hoarding. Third, low leverage. Households and businesses have borrowed prudently, and the debt service burdens are historically light. So again, the reason why we like to pull these out because it's all different ways of thinking all the way across through. Some are more on the optimistic side, some are more cautious. We kind of take all of these into account when we're going through this. So This concludes our presentation today. Wanted to thank Trevor for starting us off, and then on behalf of all of Wilde Wealth Management, we wanted just to thank you so much for your support and your trust that you have in us. We appreciate the opportunity to work with each and every one of you. And if you have any questions on anything that we went through today, feel free to reach out to your advisor. We'd love to dive deeper into some of the discussions if it interests you. But again, we just wanted to thank you so much for your support, and looking forward to our next time that we meet. Thanks and have a great day.